Welcome to Akesha's Foreign Exchange Made Easy class. Today is 19th session. Last day I have discussed historical volatility. Today I will discuss implied volatility and Greek option. Before I start, I would like to say that one comment from a viewer who underlined a statement which is given here, that is, future trading is a leveraged financial instrument which has the potential to generate larger returns, or at the same time the investor may suffer huge losses with a small amount of investment called margin, and this is not clear to him and seek my clarification. It is a good question. I did not say anything when I discussed the topic. Today I will explain it with an example. Now come, leverage referred as borrowed fund which is used to increase the potential return of an investment. Margin is the money borrowed from broker to be deposited as initial margin, where the trader has to pay interest to the broker for a period between the contract date and expiry date. Now, how the future trader will gain or lose, that is explained from an example. A trader purchase in cash 500 shares of a company at the rate of rupees 2,500 per share, and the total exposure is rupees 12,50,000. After 1 month, he sells shares at the rate of rupees 2,600 per share, gaining rupees 100 per share. That is, total gain will be 500 into 100, rupees 50,000, and rate of return will be rupees 50,000 divided by 12,50,000 into 100, it will be 4%. And in the same case, for future trader, he will get the same exposure of rupees 12,50,000, only deposited the margin money of rupees 2,50,000, that is 20% of contract value, and it is decided by the exchange, and gains rupees 50,000, and after deducting interest on margin money at the rate of 12% per annum, the net profit will be rupees 47,500. 12% per annum means 1% per month, and 2,500 will be deducted from rupees 50,000, and it comes down to 47,500. And rate of return will be 47,500 divided by 2,50,000 into 100, it will be 19%, which is much more than the cash purchase. Here you see the investment is 20% of the investment, that of investment of the cash trader, and the rate of return is 19%, and where the cash trader earns 4%. So profit is higher. That is, the statement said that which has potential to generate larger return, and at the same time investor may suffer huge losses. Now come, if the price comes down to 2,400 instead of 2,600, so there will be a loss of rupees 100, and quantum will be rupees 50,000. So the cash trader will suffer a loss of 4% of his investment. In the same case, for the future trader, he will suffer 19%. and which is higher than 4%. So the quantum of suffer of losses is much higher than the cash trader. So the statement is true and it is given in the form example. Now comes a problem of historical volatility. For 4 companies X, Y, Z, P, the closing price of equity share and daily natural log returns and volatilities for a 15 days are tabulated in table 2. Now come to table 2. Date is given and closing price of X is given, that is 3,800, 3,800, 500, 3,850, and next it comes down to 3,700 and so on. The daily LN return is 1.31%, next is minus 3.97% and so on, and it varies from minus 4.03% to positive 4.17%, and volatility is 2.81% for the company X. And for company Y, the closing price of equity share is increasing day by day, not decreasing. It is increasing, and the daily LN return all is positive and ranges from 0.42% to 1.77%, and volatility is 0.45%. Here you see for company Z, the price is decreasing day by day and LN return is negative. All is negative, and which varies from minus 0.42% to minus 1.77%, and the volatility is 0.45%. Now comes company P. Here it is up and down, price moves up and down. So the LN returns also that the positive 1.14%, negative 0.23%, and thus you find out the range, that is minus 0.37% to plus 0.28%. It is very narrow, and the volatility is 0.23%. Now the explanation is given here. The prices of share X company moved up and down throughout the period, and the price range changes were ranging from minus 4.03% to 4.17%, and the historical volatility is 2.81% for the period. For company Y, prices of share moved steadily upward, ranging between 0.42% to 1.77%, and the historical volatility is 0.45%. For company Z, prices of share moved steadily downward, ranging from minus 0.42% to minus 1.77%, and historical volatility is 0.45%. For company P, prices of share moved upward and downward but with small percentage, and the historical volatility is 0.23%. From the above, it may be concluded that higher volatility means price of the securities may change dramatically over a short period or long period of time in either direction, and lower volatility means that securities value may not change dramatically. And source is nseindia.com. And this is done on Excel sheet. You can apply it. Now come implied volatility. Implied volatility is market forecast. Always remember, it is market forecast of likely movement of securities price in future up and down, and termed as high volatility when it fluctuates between two directions quickly and steeply. That is, price could swing upward very high and downward very low. In low volatility, the prices do not fluctuate drastically. That means the price moves slowly up and down and tend to be more stable. Implied volatility denoted by the symbol sigma. Implied volatility is not same as historical volatility, since the implied volatility refers to the market assessment of future volatility, which is very much useful to the investor for their investment. But historical volatility measures what actually happened in the past, which is not so useful for the investors. Implied volatility does not predict the direction of price fluctuation. A high implied volatility is an indication that of big fluctuation in prices, but not with certainty that the price will rise high or fall low. It means that it can greatly fluctuate between the ranges. Low implied volatility means the fluctuation is low. Implied volatility is generally increased in bearish market of the stock market, where equity prices will decline over time, and it decreases when the market is bullish, where the equity price will rise over time. Implied volatility is used to calculate the option price, that is premium. Options with high volatility, high implied volatility have higher premium, and options with low implied volatility have lower premium. Major factors affecting implied volatility are demand and supply. If the demand of an asset is high, its price is tend to remain high. This increases implied volatility, which leads to a higher option premium due to risky nature of the option. If supply is high and demand is low, then implied volatility tends to fall, thereby reducing the option premium. The time value of an option also determines its implied volatility. A short-dated option often result low implied volatility, whereas long-dated tends to result a high implied volatility. In long-term option, the prices has more time to move to a favorable level compared to short-term option, and the effect of volatility is much higher than the short-dated option in the long-term option. Implied volatility can be determined by using option pricing model, since one cannot deduce it directly from the market observation. The mathematical option price model uses other factors to determine implied volatility and options premium. There are two models used for computation implied volatility. Black and Scholes model. This methodology is more analytical and is faster to compute and mainly used to price European option. To calculate the theoretical price of option trading, it uses 5 key determinants of option price, that is stock price, strike price, volatility, time to expiration, and short-term risk-free interest rate. And I will solve various problems based on Black and Scholes model after the option Greek. Binomial pricing model. This methodology is more computational, taking more computing power, and is mainly used to price American option. This is very accurate model as it is iterative but also very lengthy and time consuming. Now what is American option and what is European option? Because Black and Scholes follow the European option and binomial pricing model follow the American option. That is style of option. European option. European option can be exercised by the buyer of the option only on the expiration date. Here CE is referred as call option and PE is referred as put option as European style. American option. American option can be exercised by the buyer of the option any time on or before the expiration time. This is the difference. Till 2010, all index option in India were European option, while all stock option were American options. However, post 2010, all options are only European option in India. Currently, American options are not allowed in India. Next, time to expiration. The time value is directly proportional to the length of time to expiration date of the option. Similar to that, volatility on option premium. Longer the maturity of the option, greater the uncertainty, and hence higher the premium. Theta, that is time to expiration denoted by theta. The theta or time decay factor is the rate at which an option loses value as time passes. Theta is expressed in point lost per day when all the other factors remain constant. Let theta is -1. That indicates that the option premium will lose -1 point every day that passes by. For example, let the option price is ₹20 with a theta of -1, then the price will be ₹19 in next day. A long option buyer will always have a negative theta, meaning remaining all other factors constant, the option buyer will lose money on day by day basis. On other hand, a short option seller will have a positive theta. For example, an option seller has sold option at ₹60 with a theta of -1. After 5 days, the option price will reduce by ₹5, that is 5 into 1, and the option price will be ₹55. Hence, the seller can choose to sell the option on T plus 5 day by buying it back at rupees 55, thus profiting rupees 5. This is possible for short option holder due to theta. Therefore, everything else remains the same. The call option of USD INR, say rupees 70 per dollar for 3 months maturity, would be priced higher than call option at the same strike price for 1 month maturity. Hence, the time value portion of option premium will decrease with passage of time. And this is called time decay. The time value will gradually falls to 0 at the expiry. Option premium is equal to intrinsic value plus time value. You know intrinsic value, that is spot price minus strike price for long call, and for put call strike price minus spot price is the intrinsic value. And time value, you have just come from the time value. It is longer, the time value is be higher than the short period. The time value has the tendency to decline as the option advances to the expiry. If all other things remain constant throughout the contract period, the option price is always fall in price by expiry. Thus, option sellers are at a fundamental advantage as compared to option buyers, as there is an inherent tendency in the price to go down. I already discussed just. If Nifty index is trading at rupees 18,520 and strike price of call option is 18,480, that is, it is in the money, ITM, because spot price is higher than the strike price. So intrinsic value will be 18,520 minus 18,480 is equal to 40. If the total value of the call option is 20, then the option premium will be 40 plus 20 is equal to 60. If the option premium is 130 and intrinsic value is given rupees 70, then the time value will be option value minus intrinsic value, that is equal to 130 minus 70 is equal to 60. Interest rate differential between two currencies, it measures the difference between the risk-free interest rate of base currency and quote currency. As the differential increases, the value of call option increase and value of put option decrease, and vice versa. Now come option Greek. The change in option price when a particular price determinant changes, that is strike price, spot price, volatility, time to expiry, interest rate. That is, if this changes, then the option price will change. So, change in option price when a particular price determinant change, it is called Greek, option Greek. The Greek indicates the price sensitivity of option to change in price determinant. They are used for risk assessment and management. There are 5 primary Greek risk measures represented by delta, gamma, theta, vega, and rho. Now come to delta. It is the rate of change of option price with respect to the price of underlying asset. That is, if the spot price increase or decrease, then the rate of change of option price, that is premium, will also change, and that will be determined by the delta. Delta is equal to a change in option premium by unit change in price of the underlying asset. Delta of a long call and short call is always positive and ranges between 0 to 1. In long call and short call, holders wants that the market price move upward. That is, anticipating a bullish market. If market moves up, then call buyer will gain, and this gain may be unlimited. Whereas in short put, if market price moves up, then the put buyer will not exercise his right, and hence the short put will gain, and this gain will be limited to the premium received. So delta value here is positive, and it varies from 0 to 1. For delta for long put and short call is always negative and ranges between -1 and 0, because in the case of long put and short call, if the market price moves downward, then they will gain, and their anticipation will be the market will be the bearish. And so for short call, the gain will be limited to the premium received, and for long put, the gain may be unlimited. And here OTM is 0 to 0.4 OTM. What is OTM? You know that where the intrinsic value is nil, and deep OTM is 0.05, equal to 0.05 or greater than that. What is deep OTM? When strike price of call buyer is significantly above the current price of the underlying asset, or where the strike price of put buyer is significantly lower the current price of the underlying asset, then the situation is called OTM. It has no intrinsic value but traded on time value. And ATM, that is spot price and strike price is equal, the delta will be 0.5, and ITM 0.5 to 1, and deep ITM is 1. It is discussed in last class. Example: long call strike price is 8,300 and spot price is 8,400. That is, strike price is 8,300 and spot price is 8,400. So the case is in the money option, that is ITM, where the spot is higher than the strike price, and it is given delta is 0.8. Since it is higher than 0.5, 0.5 is ITM. It is for ITM the value is 0.5. So when it is 0.8, so it will be ITM situation. Premium is rupees 102. What will be the premium if the underlying price moves up 100 points to become 8,500? Now it is 8,400, and when it moves up by 100 points, it will be 8,500. The change in premium will be 100 points deviation, that is moves up into 0.8. 0.8 is delta, that is 80 rupees 80. So new premium will be 102 plus rupees 80 is equal to 182. Nifty spot is 8400. C, that is called European strike, 8500. Option is out of the money for long call, and for long put it is in the money, as spot is less than strike price. Delta is 0.25 because it is an OTM situation, and premium is low, that is rupees 20. It moves, if the spot moves 100 points to become 8500, that is ATM. 8500 is strike price and the spot price is 8500. What will be the premium? Change in premium will be 100 point, that is the increase, and 0.25 is delta, that is equal to 25. New premium, the current premium is 0.20, rupees 20 plus 25 is equal to rupees 45. Price of 6.10 GOI Government of India Securities 2031 is rupees 98.80, expected to reach rupees 99. Option strike 98.70 call option. Premium is 0.45. Delta of option is 0.55. What will be the new option premium value? Underlining to be changed by 0.20. That is 99 minus 98.80. So the premium will be increased by 0.20 into 0.55 is equal to rupees 11. New premium will be 0.45 plus 0.11 is equal to rupees 0.56. Next problem. Price of GOI securities is expected to reach 98.60. What will be the new premium? Underlining to be changed by 0.20, that is 98.60 minus 98.80. It is minus, premium will be decreased by rupees 20 into 0.55 is equal to 0.11. Revised premium will be 0.45 minus 0.11 is equal to 0.34. Now, here you see the delta is used to find out the new premium rate. Now, what will be the delta after changing the spot price, underlying price, that will come from gamma. Next day I will explain this Greek option. Today I stop here. Thank you.